We're getting to the pretty much the final weeks of the third wave. It's been quite devastating on the continent. I think what's even more concerning is that we've not seen a pickup in vaccination rates for a lot of our countries. I mean, on average, Neville, we're working at a rate of anywhere between 5 to 7%. The impact on growth has been devastating as well. Now, you noticed sort of last year and entering this year how we saw this beautiful bounce back in economic recovery across most of your developed markets, where they could shut down the economies during the course of 2020 and immediately resume activity in 2021. We haven't seen this play out because of this numerous waves. In fact, our suspicion is that because we've had these curfews and we've had restrictions on operations, we will still see those latent impacts on economic recovery. So unfortunately, Neville, our initial assumptions at the beginning of this year that this would be a year where we see recovering growth across most of our jurisdictions, fortunately, I just don't see this playing out.
But if we look at some of the quarterly numbers that have been coming out, I think a lot of our countries, second quarter numbers are almost, done and dusted. Are there any sort of outliers from a growth perspective that you're seeing that are sort of outperforming, given that we are sort of in this post-COVID, if I can call it that?
Well, not really outliers, but I would say I was absolutely surprised by Nigeria's figures. Coming in at 5% over the second quarter, speaking to just the market and how it looks like at this stage, it does seem that it's more of a statistical based rebalancing. But there's another thing to consider. We're starting to find the non-oil sector performing quite well in this market. And I think that will be a strong narrative for the Nigerian market moving forward. Speaking of just, numbers that have come in surprising, we also saw Mozambique figures come in. Now, what I, didn't anticipate was seeing a recovery in the tourism sector. It's very strange to see a 4% growth coming out of a sector that you'd expect would still be in the doldrums, given just the prolonged impact of COVID-19. So there might be a few surprises here and there, but on average, it does appear that it's still going to be pretty much constrained across most of our countries now.
Well, I mean, if the tourism sector is doing well, is that where we're going to be holidaying? Never mind. If we look at sort of zooming out in terms of where we are from a sort of global perspective, right? We see the unenviable combination of high fuel prices, oil prices, against the backdrop of food prices that are also escalating. And we're just talking about growth that is recovering. How is this sort of dynamic playing out within the sphere of headline inflation across the markets that we're looking at?
Up and away. That's probably the easiest way to describe it. Across nearly all our markets, Nev. And I mean, I'm just thinking of an environment like Cote d'Ivoire, which has really had inflation averaging 2% the past few years. It's been a non-feature. And now we're seeing headline indications of going post 4%. Mozambique has gone well above 5%. There are indications in places like Namibia that this could also shoot over this sort of 4%, 5% mark over the next few months. So there is really concern that inflation is problematic. Now, barring environments like Zambia and Nigeria, where inflation is hovering at plus 15% on average, you really get to see it across the whole continent. East Africa as well, with Kenya figures still indicating as such. And what that tells us, though, surprisingly, is that we're in an environment where inflation is picking up because of the supply chain disruptions as well, because of what you mentioned. But because of how poor growth is, our monetary policy view then dictates really that we shouldn't be seeing any rate hikes anytime soon. So without monetary policy changes, though, I have been curious regarding this accommodative stance that's being taken by our central banks. But more particularly, I'm looking at certain markets where, Zambia comes to mind, where, since the beginning of this year, they've had such liquidity constraint, and then this seems to have changed. How is that then translated in terms of how central banks are balancing both liquidity and what's been taking place in the exchange rate market? What are your views on that?
It's been an interesting time within the FX environments across the countries that we look at. I mean, if you see Kenya and Ghana, for example, their currencies have really been trading on the back foot. So, the Kenyan shilling, for example, is trading near the 110 level. It wasn't too long ago where we were sitting at 107. And if you see a similar trend within the Ghanaian cedi, where it's sort of, now we are in this 6.1, potentially 6.2 arena, and all of that is being driven by sort of corporate demand, right? Which is not really surprising given where oil prices are. Sorry. So a lot of these economies are actually net fuel importers. So, higher oil prices ultimately means that, we need more local currency to actually import. So that is putting a little bit of pressure on currencies. And then, of course, you have, the likes of Zambia, where, we've been talking about this ad nauseum, where it's effectively the outlier. It wasn't too long ago where the kwacha was trading, in the mid sort of 22 level, right? And then, of course, we had the very interesting election a few weeks ago, and now, a lot of the portfolio inflows is starting to come through into the country, and that in itself is actually helped the currency strengthen quite significantly. And then you have sort of non-event markets, if I can put it that way, where you've got the Egyptian pound, for example, that is sort of trading flat, at that 15.7 level. And that is purely just a function of, again, both increase in demand from a dollar perspective, but that is being countered by an increase in terms of tourism revenue, and also, a very, very steady supply of portfolio inflows into the country. So unfortunately, there's no one real narrative across the FX market, but sort of, idiosyncratic risks and drivers within the continent.
But then, at the same time, we've had this sizable IMF allocation, SDR allocation, 650 billion worth. And that is translated to everywhere between, an odd billion on average to 2.5 billion to 3 billion in some of our countries. The indication for most of the central banks is that they'll use this to support their current reserves or bolster liquidity. Would you say this additional ammunition is for them to keep sort of your exchange rate environment stable? What's your take on that?
Well, I think that is true for some markets more than others. So if we look at Zambia, for example, where its allocation effectively doubles its current FX reserves, that is additional ammunition to actually bolster the currency. Not that it needs any help at this sort of stage, but it sort of gives it the momentum should the central bank need to actually support liquidity. But you've got countries such as Nigeria, Egypt, whose reserves are fairly healthy. But this just goes to add to the ammo to ensure that the currencies remain fairly stable. Because we are sort of getting into tail end of the year where typically we could see some volatility on the basis of very thin trading as people like you go on holiday.
Yeah, absolutely. And like you mentioned, it's entering the festive season. We're left with a few months. But surprisingly, we still have one country that's looking to issue Eurobonds. In addition to having such a high allocation, from the SDR market, we're still having countries maintaining issuance, at least on the external side. Why don't you share some of your views around that? Of course, I'm talking about Nigeria, but are there any other
no surprises there.
Yeah.
So Nigeria is potentially looking to issue. Our estimate is sort of mid-October.
Sure.
If they do come to the market, I think that will be one of the highlights for the year. For context, Nigeria, the last time it came to the Eurobond market was back in 2018. So now we are in this environment where, as you mentioned, growth is slightly on the up. You've got oil prices that are doing okay, and you've got the central bank that is starting to support liquidity a little bit. So the narrative around Nigeria, I think, is starting to turn a little bit. So potentially when they do issue, I think that's going to be fairly interesting. But outside of that, we are in this sort of Goldilocks environment where this is the end of the European summer holidays. So again, liquidity is going to be coming through, and potentially we're going to see some interest in terms of the issuance within the market. But I think the headline as we head towards the end of the year will probably be a Nigeria issuance.